Friends, in this episode, we are going to discuss about how to select a debt mutual fund. Before that, let us recall a quote of Benjamin Franklin, who said that creditors have better memories than debtors. He was reminding people about the pitfalls of taking debt and the fact that creditors end up as winners. You too can be a winner as creditor. Believe me, you just need 1000 rupees to be a creditor. Just invest in a debt mutual fund and be a creditor. Simple, isn't it? What are debt mutual funds, you may ask? Well, these are funds that invest on behalf of investors like you and me in investment products that give fixed income. For example, government securities, corporate bonds, and money market instruments like treasury bills, commercial papers, certificate of deposits, etc. Regular income coupled with low risk is the USP of debt mutual funds. Who should invest in debt funds? It suits those who are averse to taking risks but looking for regular income or returns post tax more than bank FDs and savings account. It is also for those who have volatile heartbeats with the ups and downs of equity market, as debt funds are less volatile than their equity counterparts. If chosen properly, these funds can offer decent returns as they are tax efficient too. That is not the only benefit you get on debt mutual fund investments. These funds are relatively safer than equity funds. Investment costs are lower, coupled with high liquidity and more stable returns. Now, let us discuss how to choose a debt fund for investment. This is important as debt funds are less risky but not risk free. So, a wrong selection may result in unnecessary risk for you. Before choosing a debt fund, ask yourself few questions like: what is my risk appetite? What is my time horizon for investment? Which tax bracket I fall in? What in case of a short-term capital loss? The answers to these questions act as an enabler in choice of the fund category. The popular notion is that debt funds are risk-free. This is not true. Before moving forward, let us look at the two main risks in debt funds. The first is known as the interest rate risk. Interest rate changes and debt security prices move in opposite direction. That is, prices would fall if interest rate rises and vice versa. Prices of all fixed income investment products don't change by same amount when interest rate changes. In simple words, price sensitivity is different for different categories of debt funds. Price sensitivity to change in the interest rate is called as modified duration. The thumb rule is that the price sensitivity is higher in case of debt funds with longer duration, or volatility would rise with a longer time horizon, which means risk increases with time, and that's why it is important to have a clear idea about our time horizon before we choose a debt fund for investment. The second risk is credit risk. In simple words, it means that you should be aware of the repaying capacity of the person you are lending to. Here, it means that it is the issuer of the debt instrument is in a condition to pay you the interest and the principal on maturity. You get to know about this via the credit rating that rating agencies assign to these instruments. At this point, I would like to highlight few facts. One, that instruments with high credit risk usually offer higher returns. To take that risk or not depends on your risk appetite. Second, that credit risk is permanent while interest rate risk is a temporary phenomenon. The question is how to know the credit risk associated with the fund you invest in. Simple. All mutual funds disclose the profiles of credit rating of the instruments they have invested in every month. Another easier way to look at the YTM of the funds in the same category. Higher the YTM, higher the credit risk. Since risks are involved, so your risk appetite assumes importance. If you are risk averse, then ultra short term duration funds may suit you as interest rate risk is low and credit risk is also low. But remember that low risk means low reward or low returns. So, if you are looking for relatively high returns on debt investments, then you should opt for medium duration funds or long duration funds or credit risk funds which could carry higher risk. So, by now you must have understood the linkage between your investment time horizon and your risk appetite. In case you are looking to invest just for a few days, few weeks, few months, or for a year, then it is advisable that you opt for overnight funds, liquid funds, low duration funds. Look at short duration funds if your time horizon is 1 to 3 years. For over 3 years of investment or long term investments, you may go in for corporate bond funds or target maturity funds. If your time horizon is more than 5 years, you can look at dynamic bond fund or income funds or gilt funds. Moving on, now we will discuss why matching the time horizon with average maturity is important for selection of a debt fund. Let's first understand the concept of average maturity. Assume a debt fund has 3 bonds in a portfolio with maturity of 2, 3 and 5 years. The 3 bonds have an investment of 30,000, 10,000 and 20,000 rupees respectively. Then the weighted average maturity is 2 into 30,000 plus 3 into 10,000 plus 5 into 20,000 divided by the total investment of 60,000. This comes out to be 3.17 years. Why are we talking about average maturity, you may be thinking. The reason is that it has a direct bearing on the risk and returns. Before moving forward, let us understand the relationship between interest rates and bond prices. Both are inversely related. That is, when interest rate rises, then bond prices will fall. So the net asset value or NAV of a fund would fluctuate with changes in bond prices and interest rates. Over a long period, interest rate is bound to fluctuate and this would impact the bond prices, which in turn affects the NAV. This means that a fund with bonds of longer maturity would be more volatile, carry higher risk and thus may not offer stable returns or may not match your expected returns. For example, liquid funds make investments in money market instruments and thus are less volatile, carry lesser risk than gilt funds which invest in long duration bonds and are more volatile and carry higher risk. More risk means more returns. So gilt funds give more returns than the liquid funds. This explains why it is important to match average maturity with your time horizon in fund selection. Have you ever thought why returns on schemes of same category of debt funds of different mutual funds differ? Well, the primary reasons are modified duration of the portfolio, credit quality of the portfolio and expense ratio. Let's take them one by one. Expressed in years, modified duration measures the sensitivity of the portfolio to the interest rate changes. As already discussed above, bond prices fall when interest rate rise and portfolio with higher modified duration carry more interest rate risk. Now, let us see the impact of portfolio credit quality on returns. Normally, the debt instruments with lower credit rating offer higher returns than higher credit rated instruments. Higher returns come with higher risk. Credit ratings directly impacts the bond prices. When rating is upgraded, bond prices go up and yields will fall. Exactly the opposite happens in case of a downgrade. Thus, credit quality of a portfolio directly impacts the returns. For example, a short term fund with a portfolio of low credit rated bonds may offer higher returns than a short term fund with a portfolio of highly credit rated securities. Moving on to expense ratio, in simple words, it is the amount of money that a mutual fund takes from you as a percentage of your investment to manage your funds. Since the impact of expense ratio is more in debt funds where the returns are low in comparison to equity funds, the debt funds have lower expense ratio when compared to equity funds. To find out the expense ratio, you can go to the fund's website and click on disclosure and browse. However, I would add a word of caution. Don't go by expense ratio alone, as many funds with higher expense ratio are giving higher returns too. Last but not the least, you must know about the taxation of debt mutual funds. Returns on debt funds held for less than 3 years attract short term capital gains or STCG tax. Tax rate is same as the income tax rate for the tax slab that you fall in. Thus, it is important for you to be aware of your tax bracket. Suppose you make a gain of 1 lakh rupees and you fall in the 30% tax slab, then your liability would be 30,000 rupees if you withdraw before 3 years. In case you sell your debt fund after 3 years of purchase, then you attract long term capital gains or LTCG tax. LTCG is taxed at a flat rate of 20%. However, you get the benefit of indexation. Indexation is nothing but adjustment of your purchase price for inflation. This increases your cost of acquisition. Result is that your capital gains get reduced and thus you pay less tax. This is an exclusive benefit you get in debt mutual funds when compared to traditional debt products. Also, if you incur a short term capital loss, you can offset it against the short term gains or long term gains that you may have made. What this means is that your gains go down and your tax liability decreases. To summarize, if I have to choose a debt fund in particular category across all mutual funds, first I will shortlist the category based on my time horizon, match it with the average maturity. Based on my risk appetite, will choose the funds either with less or more interest rate risk, less or more credit risk, and finally look at the expense ratio of the scheme. Also, if your time horizon is less than 3 years, to get better post-tax return, you can also look at arbitrage funds and equity savings fund based on your risk appetite. Really दोस्तों, म्यूचुअल फंड सही है. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.